All right, let's get straight into it. Today, we're doing a full exam-focused deep dive into Accounting Standard 15, Employee Benefits. Now, this is a standard where ICAI absolutely loves to set traps. But you know what? By the end of this, you're going to be able to spot them from a mile away and just breeze through. Let's do this.
So let's kick things off with a classic exam-style question. An employee has 100 days of earned leave, and they can carry it forward. Now, what's your first instinct? You probably want to say short-term, obviously. But is it really? This exact scenario is where so many marks are lost. You see, getting this one classification wrong can cause a huge domino effect. It messes up your accounting treatment and, yeah, ultimately your final marks. But hey, don't worry. We're going to break it all down, step by step, so you can tackle any version of this question with total confidence.
All right, let's start at the very beginning with Section 1, the basics. Look, you gotta get this part right because everything else we talk about is built on this foundation. So what are we even talking about here? Well, AS-15 is all about accounting for any kind of payment or reward a company gives to its employees for their work. But here's the most important thing, the one principle that drives this entire standard, the matching principle. You have to recognize the cost of the benefit when the employee earns it by working, not necessarily when you pay for it. Got it?
And you need to understand that the scope here is huge. The standard casts a really wide net. We're not just talking about your full-time permanent staff. Nope. It covers everyone from casual workers to whole-time directors. The benefits themselves can be cash or something like housing. Heck, they can even be paid out to dependents or to third parties like an insurance company. It's broad.
Okay, now listen up, because this is a classic ICAI trap. You need to know the difference between a contract of service and a contract for services. A contract of service, that's your typical employer-employee relationship where the boss has control. That's covered by AS-15. But a contract for services, that's more like outsourcing a job or hiring a consultant. There's limited control, and it is generally not covered by AS-15. If you mess this up in a question, your entire answer is wrong from the get-go, so be careful.
The standard basically sorts all these employee benefits into 4 main buckets. Just knowing these categories is the first step. We're going to touch on all of them, but we'll really focus on the ones that cause the most headaches in exams, starting with short-term benefits.
Okay, let's dive into our first major category. Section 2, short-term benefits. The definition here seems simple, right? These are benefits that are expected to be settled wholly within 12 months after the end of the period when the employee worked for them. And that word wholly, that's the key. Now, the accounting for these is usually pretty straightforward, which is nice. You don't need any complex actuarial math. You just recognize the undiscounted amount as an expense. So, for example, if the total salary expense for the year is 2 crore, but you've only paid out 1.9 crore, you still book the full 2 crore as an expense and show that remaining 10 lakhs as a liability. It's just simple matching. Okay, let's talk about paid leave, or what the standard calls compensated absences. This is where the rules start to get a bit more interesting. First, you have non-accumulating leave, like maternity leave. This one's easy. You only record the expense when the leave is actually taken. But then you have accumulating leave, the kind you can carry forward. For this, you absolutely have to accrue the expense as the employee is working and earning that future leave. Now, this accumulating leave splits into 2 types, and it all comes down to one question. If the employee leaves, do they get cash for their unused days? If the answer is yes, we call that vesting. If it's no, it's non-vesting. For both types, you still have to accrue the expense. The only real difference is that for non-vesting leave, you also have to consider the probability that some employees might leave before they get to use their entitlement.
Okay, this brings us to Section 3, the heart of the problem we started with. This is the paid leave trap. This is where a benefit that looks short-term on the surface can sneakily become a long-term one, and that changes everything.
So here it is, the answer to our opening question. Let's say an employee has 100 days of leave piled up. But if the company's policy or just the way things usually work means they're only expected to use, say, 30 of those days in the next 12 months, then that key phrase, settled wholly within 12 months, is broken. And because it's not settled wholly, the entire benefit for that group of employees gets reclassified as a long-term benefit. And that means more complex accounting is needed. So here is the absolute crucial exam tip you need to write down. It's not about how many days an employee is entitled to carry forward. It's all about what the company realistically expects to settle in the next 12 months. And this isn't about one single employee. It's based on the overall pattern for the whole group.
And by the way, this same logic applies to other things too. Imagine employees can carry forward their unused medical allowances. The company has to recognize a provision for that. And that provision has to be based on the service they've already provided to earn it. And, super important, you have to factor in the probability of employees actually using that benefit in the future.
All right, let's totally switch gears now and move on to Section 4, post-employment plans. This is all the stuff that gets paid out after an employee leaves the company. Think gratuity, pension, and your provident fund.
Now, within post-employment plans, there is one distinction that you absolutely positively must master for your exams. It's the difference between a defined contribution plan, or DCP, and a defined benefit plan, or DBP. Your entire accounting treatment, every single step, depends on getting this classification right.
Pay very close attention to this slide. Maybe even take a screenshot. In a defined contribution plan, like a provident fund, the employer's job is simple and fixed. They just pay a set amount. That's it. The employee bears all the risk if the investments don't do well. Accounting is easy. You just expense the contribution. But in a defined benefit plan, like gratuity, the employer promises a specific benefit amount at the end. This means the employer is on the hook for all the investment and actuarial risk. If the fund is short, the employer has to pay more. The accounting is way more complex. The key question you always have to ask is this: who bears the risk? Now, for our final puzzle in Section 6. A lot of companies fund their gratuity by paying premiums to an insurance company. So you might think, okay, they're just paying a premium, so it must be a simple defined contribution plan, right? Well, this is a very common point of confusion. Here is your exam day framework. It's a simple checklist. First, is it funded by insurance? If yes, then you ask the most crucial question of all. If the insurance company, for whatever reason, fails to pay the employee the full amount they're owed, does the employer have to step in and make up the difference? If the answer is yes, then the employer still holds the ultimate risk, which makes it a defined benefit plan. If the answer is no, and the employer's only job is to pay the premium, then it's a DCP. In India, most of the time, the employer does have that final obligation, so it's usually a DBP. And one last tiny but important detail on this: how you show it on the balance sheet. Getting this presentation right is key to full marks. If the money held by the insurer qualifies as plan assets, you can net it off against your liability. But if you only have a reimbursement right, you have to show the full liability on one side and then the right to be reimbursed as a completely separate asset. It's a subtle difference, but it matters. So let's boil this all down. What are the key takeaways for your exam? Number 1, the matching principle is king. Always match the costs to the service period. 2, for paid leave, it's all about when settlement is expected to happen, not just what they're entitled to. 3, for DCP versus DBP, the only question that matters is who bears the risk. And finally, remember that insured plans are usually DBPs if the employer is still on the hook at the end of the day.